Starting with no credit can feel impossible. Why? Because nobody wants to approve you and you need credit in order to get credit. So how do you go from having no credit at all to an 800 credit score? Perfect timing. Stick around and watch this entire video until the end, and I'll break down how you can do this step by step. Number one, you need to understand first how credit works, okay? There are 5 major factors in what make up your credit score. Number one is going to be 35% of your credit score comes from payment history, okay? That's essentially, are you paying your bills on time? If you don't, then your credit score is most definitely going to drop. The second biggest factor is going to be utilization. Now, 30% of what makes your credit score is essentially the utilization, or also known as usage. How much of your credit are you actually using? So credit, the algorithm is looking for you to have access to a lot or access to a certain amount, and you're not using as much as you have access to. So I'll give you a numbers example. So let's say, for example, you have a credit card. The credit card has a $1,000 limit. If you have a $700 balance, then to calculate that, you take the balance and you divide it by the limit, okay? Now, when you do that, using those numbers, that's 70% utilization because you took 700, you divided it by 1,000, okay? Now you have a 70% utilization. That's far too high. The number that you want to stay under is about under 10%. 7 to 10% is a very good window that you want to be in. That doesn't mean that you can't use your credit cards. That just means that if you do use your credit cards more than 10%, you're going to start to see a little bit of fluctuation in the scores. You go past 30%, you're going to start to see your credit score drop, okay? So that's where you want to make sure that you're not using too much of that. The third biggest factor is 15%, and that is credit length history. This is the average age of accounts. How long can you keep accounts open, okay? So you really can only do this with revolving accounts. There's 2 different types of accounts that's on your credit report. You have revolving, those are credit cards. They call them revolving because the balance can change, it always changes, the limits change, things of that sort. However, with revolving accounts, you can keep those open as long as the financial institution allows you to, or as long as they stay open, right? The other account is going to be what they call an installment account. Now, an installment account is any account that ends in the word loan, okay? That's going to be a personal loan, student loan, auto loan, or a mortgage loan. Those are all installment accounts, okay? And you need those mixed, and we'll kind of get into that in a second as well. But when you have an average age of accounts, what you want to do is you want to have accounts open for a long period of time. Now, that doesn't mean that you can turn a 4-year auto loan into a 6-year auto loan. That means you haven't been paying them, okay? Because that balance is supposed to be coming down. That's where revolving accounts come into play, because with revolving accounts, you can have that account open for 5 years, 10 years. I've even seen people with credit cards open for 30 plus years, okay? So again, it's most definitely possible. If you're looking to increase your credit score, qualify for homeownership, or lower your monthly car payment, we can help you. We can take a look at your credit report and create a custom game plan for you to help you accomplish your credit goals. Scan this QR code or click the link in the description below. Now back to the video. The fourth factor is a factor that isn't talked about as much, and that's going to be 10%, and that goes with credit mix. So this goes into talking about revolving accounts, installment accounts. You're gonna naturally just get accounts over your time frame of just living, really. So let's say, for example, you get a credit card, then a couple years later, or a couple months later, really, you get another credit card, another few months later, you get another credit card. That's 3 accounts right there. You end up getting a car, now you have 4 accounts, you get a house, that's 5. So that's how quickly that can happen. We're not even talking about personal loans, student loans, secured credit cards to help you to get started. So all of those things play a role. And the 5th factor that makes up your credit score is going to be 10%, and that is new credit, okay? Or new credit accounts. Essentially, how much are you getting new accounts on your credit report? This doesn't mean that you want to keep getting new accounts. This is essentially keeping you from getting too many accounts in a short period of time. I always like to tell my clients, listen, what got you here won't get you there. So when you're in the 300s, 400s, 500s, that's a completely different strategy to get to the 600s, 700s, and 800s, because you may open up 1 or 2 accounts in the lower score tiers and then get 75 points. You're thinking, oh, let me just keep opening up new accounts so I can keep getting 75 points. It doesn't work like that. It more so transitions from getting accounts to how long can you stay consistent with paying them on time and using them properly and knowing when to add accounts and knowing when to close accounts potentially as well. Now that we have the basics out of the way, let's go ahead and talk about how you can actually go from 0 all the way up to 800. Now, keep in mind, this is just 800, not 850, okay? To get to 850, you need 5 to 7 open accounts, and you gotta have them open for 8 to 11 years. This strategy will have you'll be able to see those similar results in less than 3 years, maybe around about 2 years, depending on how fast you get these accounts open. This method, you still need about 5 to 7 accounts. You can get away with about 5 accounts, and then you don't have to have them open that long. About 3 years or so, 3 or 4 years or so, you'll most definitely start to see your credit score get to that 800 range for sure, okay? Now, if you're starting at 0, that means you have to start somewhere. There's 2 ways that you can get an account brand new if you're brand new to credit. And that's going to be technically 3 ways, but one of them are different categories. So that could either be a credit card or a credit builder. That credit card can be either a secured card or an unsecured card. If you go with a secured card, that just simply means that you have to give a deposit in order to get access to the card. There are companies like Capital One that have deposits as low as $50, $100, or $200. And then you have some companies like Open Sky where it's a flat $200 and they don't run your credit. So you can get denied for a Capital One secured credit card if they're running your credit and they don't like what they see. Versus Open Sky, it's gonna cost you more, but they're not looking at your credit. That's if you go with a secured credit card. You have an unsecured credit card, you can start off with Capital One or any company that you want, really it's up to you. But different companies are gonna have different fees and such. But once you do that, no matter which credit card you go with, you most definitely wanna make sure that you're using a very small amount of it. So with credit cards, going back to what we learned earlier, utilization. You wanna make sure that you're keeping your balances under 7 to 10% utilization. For example, if your credit card limit is $1,000 and you want to stay under 10%, 10% of $1,000 is going to be $100. So that doesn't mean that you can't spend more than $100, but if you do, your credit score is going to kind of fluctuate, okay? So if you want to stay under $100, how do you do that? It's simple. Look for bills that you already have that's under $100, then put it on that credit card, just changing the payment method, put it on auto pay, okay? That's like stuff like Apple Music, Hulu, Spotify, gym membership, cell phone, whatever you got that's under 100. Real quick, be sure to download our free ebook today. All you gotta do is scan this QR code right here or click the link in the description below. Now back to the video. You don't have to max it all the way out to 100. A couple of bills, even if they add up to be $75 or whatever, as long as you're staying under that $100 and you're using that. Now that's the first thing you wanna do. Now another option to that, an alternative, or you could do both, and this is essentially getting a credit builder account. Now, a credit builder account is also known as a secured CD, okay, a certificate of deposit. Essentially, it's a savings account that you pay in every single month. But what they do is they report each time that you pay to all 3 credit bureaus. And at the end of that term, not only are you getting that payment history added to your credit reports, all 3 credit bureaus, by the way, but they are essentially, as you're paying into it, and when you get to the end of that term, they give you the money back that you put into it, okay? So that means you're essentially saving money just by, you're building credit just by saving your own money, okay? So keep those things in mind. You can go with a secure credit card, you can go with an unsecured credit card, you can go with a credit builder, you can go with all 3, and that's gonna help you as you start adding more to your account history. The next thing that you wanna consider is adding your utility bills to your credit report. Now, all of your utility bills, or just bills in general, won't be able to go on a credit card, or who knows, your limits may be high enough to carry all of your monthly bills. But you want to save a couple. Here's why. You want to be able to add those utilities to your credit report, okay? Now, one of the accounts that we recommend for this, and there are credit monitoring companies that do this. You got Experian Boost that does this for free, but we recommend a company called Grow Credit. Now, Grow Credit, they allow you to add multiple accounts to your credit report, and essentially they have to be subscription services like Netflix, Hulu, Spotify, Disney Plus, the list goes on. And they also allow you to do this with your cell phone bill. Either way, they add that credit history to your credit report, and you're easily able to pick up some points just by going that direction as well. Now, another thing you can do is becoming an authorized user. An authorized user is someone that's added to someone's credit card. Now, this means that their payment history, their balance, their limit, and the age of the account is all going to show up on your credit report, okay? but there is some risk there if you don't have these certain parameters in place. Number one, payment history. Then we're talking the last 4 years is going to show up on your credit report. So you need to confirm with eyes that the payment history is flawless. Otherwise, if you got some late payments, not only could it be a waste of time, but it could also drop your credit score as well too. Now, some other things you got to keep in mind is you're vulnerable. So if they swipe that credit card, you will be affected. They close that credit card, you'll be affected. If they file bankruptcy, if someone steals their credit card, all of those things that happen to regular, normal day, everyday people could most definitely show up on your credit report, okay? So to reduce the risk of certain things happening, I would recommend being an authorized user on someone's credit card that you know, a family, a friend, a spouse, something like that. That way, if they do use the card, they're a phone call away, they're a text message away. You can drive to them if you needed to, right? Versus some people do what you call a trade line. Same thing, but they're paying to be on someone else's card. Problem is, they don't know who that person is in most cases. So you have someone that has your first name, your last name, your social security number, because they're gonna need that in order to have it go on your credit report. And so now you have multiple people with your personal information. You don't know who has this information. That's number one. Number two is that you could also find yourself in a situation where, when you're added to someone's credit card account, they associate your information with the primary account holder's address. So now they're getting mail with your name on it for other credit card offers that you really do qualify for, and it's going to their house. A lot of people don't talk about that, but it most definitely does happen. Also, if they add too many people on their credit card, that account may get closed. And again, that could potentially hurt your credit score. Number 4 is keeping your utilization low, okay? So now that you got some credit cards, listen, you're gonna get credit limit increases. You're gonna get offers in the mail for higher limit credit cards, better banks, better tiers, better opportunities. Just making sure that you're not constantly saying yes to everybody. Just because you get 5 credit card offers doesn't mean you gotta say yes to everybody. Everybody throws away mail. It's a part of the game, a part of the deal. So it's not uncommon that you just shouldn't be in bed with everybody, okay? You can't have a relationship with every single bank. Technically you can if you want to, but if that's your strategy, do understand it's gonna take a little bit longer to get to 800 because now that's gonna affect your average age of accounts, which we talked about earlier. And adding too many accounts too fast is most definitely going to play a major role when you're trying to improve your credit score to 800 and beyond. Then number 5, paying everything on time. Making sure that things are on auto pay, okay? You don't want to put yourself in a situation financially where you're not able to make the monthly payments on time. When you have these accounts on auto pay, that's most definitely going to be a game changer and help your credit score out big time. And number 6, make sure that you avoid too many increase all at one time. This just simply means that you're applying for too much credit too quickly. Not only does this affect your new credit if you're approved, but then you're just constantly adding too many new inquiries. And what's going to end up happening is, now inquiries are not worth that much, but those 3 to 5 points add up if you're constantly having someone run your credit and with a hard pull. Now, if it's a soft pull, meaning you're looking at your own credit, you don't have to worry about that. But if it is a hard inquiry, a hard pull, it's most definitely going to be, on your credit report every single time that happens. So you most definitely want to keep that from happening. Now, again, you need 5 to 7 accounts. You need to have them open about that 3-year mark, 4-year mark, and you're going to start to slowly see your credit score. Not slowly. At the beginning, once you're under 700, you'll see that quicker. Once you get it past like about 680, 700, that's when it starts to slow down. Why is that? Because now the algorithm is not just looking for positive activity. The algorithm is now looking to see how long can you keep doing what you have been doing. And again, that's going to play a major role in making sure that you get the foundation, especially since you went from 0 all the way to 800. Let me know inside the comment section below which one you like the most, which one has been working for you the most. And of course, we'll see you guys at the next video. Thanks for watching, and we'll see you guys on the next video.